I find the alternatives investment space fascinating. Equally, I find the WAM Alternatives listed investment company fascinating for a few reasons. Firstly, it invests in long-term investment trends that are shaping society, from digitisation to our ageing population and food scarcity. Then there's the way that it goes about gaining that exposure to these investments. How do you actually invest in the ageing population, and how do you decide which is the actual best way to get exposure to it? And what's an acceptable return from these trends? What structure do you hold it in? Finally, WMA comes with its own transformation story as well. You might remember back in 2020, the collapse of alternative asset manager Blue Sky. It was a Queensland-based alternative asset manager. In 2017, it was actually valued at just over $1 billion. Rising from the ashes, or the wreckage, was the Blue Sky LIC. That was rebadged in 2020 by Wilson Asset Management. Now, 5 years down the track, I actually caught up with new portfolio manager Nick Kelly, and this episode is brought to you in conjunction with the Australian Shareholders Association. Mate, let's start with the Nick Kelly story. Where did that start?
Yeah, thanks, Mitch. Grew up in Sydney boy all my life. I've travelled around, but never spent sort of time working overseas. So always in Sydney, grew up on the northern beaches, lived south for a while and back up on the north side now. Hard to leave the best city in the world.
I'll settle down. I managed to. Now, what was let's go into actual investing. What was your first experience with investing?
Yeah, sure. So I was thinking about this. I think it would have been immediately after finishing school. So I did a cadetship with PwC. So I was working for them and also doing university part-time and started to become more interested. Being young and fairly inexperienced in markets, I found myself trading derivatives, trying to make a quick buck. So started with sort of options and ended up doing some CFDs and things. And I think I liked how quickly it all happened and the fact that, overnight things could move. And so that's sort of where it all started. That was really the interest for me. And then over time, it's obviously evolved. It's evolved since there, but that's where it probably started.
Let's talk about that evolution, because that's something I'm always really interested in, because we're always evolving, even professionals as an actual investor. But when you look back and you look at the things that were incredibly influential and shaped you as the investor you are today, is there any pivotal moments or people that you can point to or lessons that you point to and say, hey, that really shifted your overall investment philosophy?
Yeah, absolutely. So it was probably when I joined Willis Towers Watson, where I was prior to joining WAM, and I was there for 12 years. And so when I joined there, the one thing that was instilled into me from day one joining there was long-term investing and the fact that you can generate alpha over the long term if you're patient, you trust your process. And so I think that's probably where it started. We had a group there called the Thinking Ahead Institute that used to think ahead, as the name implies, of sort of themes that were going to impact markets, but well into the future, sort of 20 years plus. I actually wrote a paper back in early 2000s that included the pandemic as one of the great risks to society. And to their credit, actually never after, I know, and to their credit, when COVID happened, I thought, they'll recycle that paper and tell everyone they'd written about it, and they didn't. That was a sort of the very humble sort of investors, but exceptionally bright group of people, and in particular Roger Irwin, who sort of founded that group and founded the investment consulting business at WTW, was probably someone that I looked up to and just thought differently about markets.
What asset classes I've not heard of that organisation. So what asset classes did they mainly invest in, and who did they manage money for?
Yeah, so we invested on behalf of all institutional clients. We, WTW, advised on about 4 trillion of assets globally. So all institutional sort of pension funds, super funds, large endowments, foundations, and it was moving into wealth as well, across all asset classes, both on an advisory basis, and we managed portfolios well on behalf of clients.
And some people may or may not have just picked up, you mentioned we as in like the organisation that is still
That's
being
right.
there. That's because you're really fresh.
I am.
At the WAM stable.
Yes.
How long have you been there for in the seat now?
4 months earlier this week, 4 months. Yeah.
Fantastic. We'll get into that a little bit about, because I'm actually also interested in your mindset of inheriting someone else's portfolio.
Yep.
Because this is almost, when we do get into it, this is almost the, another new set of hands on WMA, because the LIC, it's an incredibly fascinating one. If you go back through the history of it, it originally had a different name, different manager, different lot of holdings, and then, of course, went into the WAM stable. Dania, who we have had on the podcast before, we'll link to that one in the show notes, was managing it, and now you've moved in, and you worked alongside Dania for a long time.
For a long time, yes, exactly.
Great. So I'm interested in how it feels like inheriting that portfolio and picking that up and moving forward with it, because you've got to be comfortable with all the holdings.
Absolutely. And look, to be honest, joining was easier because I obviously worked very closely with Dani. I knew the portfolio she had built. I was very familiar with lots of the underlying names because we'd both been trained in the same sort of organization, the way of looking at researching individual fund managers and building conviction in these groups and how we think about private markets investing. And so that bit was actually probably easier than maybe others joining, or if I'd come from a very different background with a different thought process, it would probably be very different. But that was really the attraction for me, sitting there going, actually, this is a cracking portfolio that's been built. And of course, I want to put my stamp on it and make a few tweaks, but they are at the margin. They're just sort of enhancements to a really strong foundation that's been built by the team before me.
Awesome, mate. Let's have a chat about the portfolio now, and what you've mentioned just before about thinking about long-term themes, long-term mega trends that are going to shape the economic landscape of the world. When I think about an alternative asset manager, that is a part of what I think about, because the alternates is a huge space. It could be just about anything that doesn't fit into a traditional basket goes into your alternatives. And so that really gives you guys scope to invest in any extra trends, et cetera, that you pick up on that are investable. It's actually quite interesting how you start. When your world is so big, how do you pinpoint a start point?
Yeah, it's a tough one. And you often get this question: is it bottom up or top down? And it is a mixture, right? So you can have a view that so we play 4 major themes through the portfolio: so aging demographic, the energy transition, food scarcity, and digitalisation. And so we start with sort of those 4 themes, and most of our underlying strategies will feed into one or more of those themes over time. But it's got to be bottom up too, because you might sit there and go, okay, well, the aging demographic, we want to have exposure to that. And then we start digging into various asset classes. We can get exposure to it. So say private equity and real estate, which we have exposure to through the portfolio. But you could find, you might not find a particularly skilled manager in that space, right? And so we're not just going to go, well, we want exposure, let's just give money to whoever to manage to try and get exposure to this theme. And equally, you might find a really good manager, but not the opportunity set at that point in time. And so all the things have to sort of line up, and that's why it becomes this sort of combination of both the top-down piece, but also the bottom-up research that we do on the various investment partners that we've got in the portfolio.
Awesome, man. Let's start with digitisation. Can you explain that theme, and also then explain the way in which you've chosen to go after the theme and why?
Yeah, sure. For digitalisation, which is all about, the world is hungry for more data, right? There's this constant need for it. And so the easiest way to play that is through data centers. So we do have exposure to data. And then if you then do the step before that, it's around energy. Right. And so there's clear link there around the transition theme and digitalisation, which we best play through our infrastructure exposure. And so getting access to assets, both in the data space, but also through renewables and other elements of the sort of energy transition where those two things are linked. And so it's really working out where to play it. And we do get some exposure as well through the private equity portfolio.
Looking at that as a specific theme, I think a lot of people could sit around and they'll hear that and they'll nod. But for it to get a role in the portfolio, it's got to get a return.
Absolutely.
And
absolutely.
When you sit back and say, right, digitalisation, electricity utilities or energy utilities, data centers, et cetera, how do you build out your return expectations around that to build the investment case for it to be, to be putting people's capital into it? What is your expectations from this?
Yeah, absolutely. So the return's got to, we've got to be compensated for the risk we're taking, right? If we're taking elevated risk, we need to be paid for it. It's as simple as that, right? So, renewables is a classic case of that. You go back sort of 7-8 years ago, renewables, you could get sort of 8 to 10% plus in terms of returns pretty easily. There was deals available in the market. That number's now has come in a bit, right? A lot of capital's come into the space. A lot of funds have been raised. And as a result, the return expectations have come down. Now you've got to sit there and say, well, has my risk profile also reduced? In which case you could still do it. Or if it hasn't, actually, are we getting paid enough, right? And so you're sort of constantly going through this balancing of the portfolio to say, are we getting paid enough for the risk? There needs to be a commensurate return for the risk we take. And so that's sort of how we build it out over time. And the expectation for WMA as a whole is that this portfolio should generate around 10% returns from the mixture of the underlying strategies that we've got.
Yeah, that's what I was wondering, because you've surely got to first say, hey, what's an acceptable return overall for this portfolio? What are shareholders going to accept for the risk that we're going to take? And then you can build the portfolio back from there and say, rightio, if we're wanting 10, we can have a bit of this, bit of that. We can take a little bit less risk off the table over here and build this mosaic of returns.
Exactly. Yeah, spot on. So 10% plus in terms of return profile with sort of half the volatility of equities is sort of what this portfolio should deliver over the long term. Yeah.
Right. Fantastic. Now, let's jump into food scarcity. Let's talk about that one. And how does this play out in business, in investable businesses, food scarcity? And what does food scarcity actually mean? It's not like during COVID when you go to the supermarket and the shelves were bare, or all the items to make spaghetti bolognese was bare. So what does that really mean in the world and for investors?
Yeah, sure. So the scarcity theme we really play via the sort of commodity input. So the key one being water. So we have a quite decent holding to water, which we'd inherited from Blue Sky, and we'll get into obviously some of the challenges that business had. But one of the sort of perhaps the only bright star within that business was really the water business, and that was the really institutional quality part of the business. And so we continue to like that part, that piece of it, and we continue to manage it. And we like that theme, that water theme. Water is a wonderful diversifier in a portfolio, but it also plays that theme of scarcity. So we own, via our investment manager, we own water entitlements in the Murray-Darling. And then based on sort of rainfall each year, there's an allocation associated with those entitlements. And then you can trade those allocations or you can lease them to farmers. And so this market ensures that water ends up in the right place where it's needed, frankly. So we think it's a really interesting market. It's its own little niche market in itself. When you sort of talk about it, people are like, really? There's a traded water market?
Yeah, who regulates it?
So there's a water regulator that sits over the top of it. And then the participants in the market, there's some institutional groups like our investment partner that we use, but also agribusinesses and irrigators, large farmers. And this all came about many years ago. The government put in place the Commonwealth Water Act back in 2007 that separated water from land. So previously when you bought land, you get the water. Now those two things are separate. So the irrigators themselves could have big properties and they're sitting there going, actually, we'll trade our water. We don't need as much of it this year, right? And so it's a traded market. It's a fairly efficient market. And as I said, we think it's playing that theme, but it's also a wonderful diversifier in a portfolio, which we like as well.
So this is kind of sound, in my head, this is a dumb question. How much does water cost?
How much does water cost? So at the moment, per megalitre in the southern Murray-Darling, where we are, is about 250 a megalitre, which is quite a bit higher than we were 12 months ago. I think it was sub 50 a megalitre, but well below, we were 700 megalitre 4 years ago after significant drought. So Chemi is quite volatile. So the actual water pricing can move around quite a bit, obviously depending on rainfall. And then it's a question of, if it's rained a lot and the dams are full, then the allocations are high. What you tend to find is your farmers are less likely to lock in long-term leases, right? Because water's cheap and pretty available. And then obviously as you can imagine, the basin reduces, water's a bit tighter, then there's a desire to lock in leases. And the other piece that's interesting here is that we've had the Labor government with the Greens have made a promise to buy back all the entitlements in the Southern Murray-Darling Basin. And so there's a bit of pressure in terms of supply potentially coming out of the market. Demand is still there. We've had a pretty dry summer. And so actually there's some pretty strong sort of tailwinds, we think, for water looking forward. Clearly, we don't know if it's going to rain tomorrow night. I always joke that, meteorologists have the best job because they can get it wrong and, they still show up for work the next day. But it does feel like there's some pretty strong thematics behind water at the moment in terms of where it's sitting and tailwinds for the sector.
And let's just dip into aging population as well.
Yeah, sure.
'Cause that's the other major one that you guys have in the portfolio.
Yeah, so aging population, so the aging demographic, we play through mainly private equity and real estate. In private equity, we own a number of businesses that play this. So radiology-related businesses, medical-related businesses. We've got a private equity partner we use that has a particular skill set in healthcare. So that's sort of their DNA. And it's also a neat complement for a lot of investors who hold listed equities. Healthcare tends to be underrepresented. If you think about top 10 stocks in the Aussie index, right? It's banks and it's financials and miners. And so playing healthcare through private equity is a neat complement. So we get healthcare through that, and also through real estate. We own a number of private hospitals via our investment partner, Barwin. So we've got 30 private hospitals. And we like that really defensive, strong income generation, not particularly economically sensitive, and plays that theme really neatly. So we like that space.
A lot of what we've spoken about here, if we were to put it in a region-specific kind of context, does sound Australian-focused.
Yes. Yep.
Is that what? Yeah.
So it's all Australian. So the portfolio is largely pretty much all Australian now. There was some offshore assets we inherited when we took the portfolio on from Blue Sky. There's nothing stopping us investing offshore, but given the work that was needed in repositioning the portfolio, there was a desire to stay domestically focused. And so that's definitely the plan in the short term. Perhaps over time we will look to move offshore. The portfolio is also not massive, so we haven't needed to, right? It's a $230 million portfolio. It's a neat size where we get access to these markets, but we can be, significantly larger than this over time. And as we grow, we'd look to probably invest more offshore, but we just haven't. There's not been a real need to do that as we've managed the portfolio.
There's enough deals to get you the desired returns for the risk that you're prepared to take domestically for now.
Correct.
Okay. Yeah. One thing I know you're also holding the portfolio is private credit.
Yes.
How does this fit in with the themes in the portfolio?
Yeah, sure. So we play the theme. So aging demographics, a good example. We've got a loan to IMED, another radiology business. So we get it through the underlying loans that these groups provide to these businesses. So particularly healthcare is a good one, and some energy transition businesses as well. So engineering businesses that play into this space as well. You think about all the solar farms that have been built and wind farms. There's engineering firms and others that need to be across that benefit from that as well. So that's how we play it. It is a small portion of the portfolio, just under 5% at the moment. We'll increase to sort of 10%, but it is a sector we're watching very, very closely. As you know, there's been a ton of capital that has been raised in this space. When I started researching private credit, it was back in 2016, and there were 3 groups in the market, in the Australian market, raising money. And I heard from someone the other day when we were catching up with someone up in Brisbane that they said they'd heard there was 300 now raising capital, which is just it's mind-blowing how much capital.
Definitely something new to the Australian market. It's not new globally.
Correct.
But it's new to the Australian market. 300 though sounds a bit too much.
It's far. Look, it is too many, right? And I think for me, this asset class will continue to exist. It has its place in portfolios. It is a great complement to the banking system, right? No issues with that. But private credit in a client portfolio, an overall portfolio, should be 5 to 10% max of a client's exposure. And I think if we think about that, I think there's something like $200 billion has been raised in private credit in the Australian market. And my concern is, I don't think that has all been invested in a disciplined way. And as a result, you're going to see some cracks appear. The other challenge we've got in this market is we haven't really had a really significant credit cycle. The US did through the GFC, right? They lived and breathed that. We really haven't. And so there's very few people in this market that have strong workout and restructuring expertise. And that sort of worries me. There's plenty of bankers out there, and it's relatively easy to go and underwrite a loan. It's a different thing to, roll up your sleeves and work it out when it goes pear-shaped. And so I think for me, I guess looking at private debt managers that we partner with, it's ensuring that they've got that workout experience and insolvency expertise and other, so that they can work things out when inevitably not everything goes well, right? You get hiccups along the way, and that's fine. And so it's really important they can then work those out and ensure we get the return for the risk we're taking.
For people who have been looking at this space, then what does that look like on a resume? That workout experience. Do you see, look, where these people have been?
Yes.
Have they had to actually cope with the fallout when things go wrong?
Absolutely. So it's think of groups, your Quarter Menthas, right? It's your Barry Hodgson's insolvency groups. It's working offshore through workout regimes, right, out of the US or Europe during the GFC. It's that sort of experience that's really, really important to ensure that they can work it out. And importantly, case study, like if you're investing into an existing portfolio and it's all held at par, question the manager. Should it be?
So when you say, just for people, when you say it's all held at par, what do you mean?
As in they haven't marked down any of the loans because they might not be performing. And there's been this sort of, everything's fine, or we'll take the equity. And it's just, in my mind, that's not good risk management. Things won't go well. Like at the end of the day, if you think about a lot of the loans that private debt managers are providing, in many cases, the banks have said no to doing those. Like we sometimes forget this, right? Like this market exists because the banks find it difficult to do it. Now, they might have said no because it doesn't meet certain requirements that don't necessarily increase the risk, to be clear. But sometimes it's just riskier, right? And so you sort of sit there and go, okay, well, that's fine. So you're going to have some defaults. Things are going to happen. What does the manager do in that situation? They mark down their loan, they're on the front foot, they're proactive, and they work it out to ensure they get, 100 cents in the dollar back. And I think it's important that, and we're seeing this from the regulator, right? This desire to regulate the sector more. And I think that's great. And that will hopefully weed out some of the groups that aren't doing the right thing by investors, and those that are will become stronger as a result. And that will be a good thing for the sector.
Well, not to age this particular podcast, but we are seeing one company go through a bit of that at the moment. They've taken on ownership of running a few of these assets, and we're talking it's metrics that we're talking about there that have taken on the running of a very famous restaurant, Rockpool, and whatnot. So you've got a live example playing out in the Australian market today.
Yeah, absolutely. And I guess that's what I'm saying. It's and that's a completely different skill set, right? And so it's important these businesses then bring in the right people to then manage it. But there's costs that come with that too. And we don't have in the US, when things don't go well as a lender, there's a sort of there's a more acceptable pathway to sell these loans at a discount, right? And go, you know what? I lent this person money, it didn't go well, I'm happy to sell it for 50 cents in the dollar. We don't really have that thinking here, that sort of process. And so there's a sort of desire for these businesses to go, you know what, we'll just take the equity on and we'll manage it. Sometimes that might be fine. Other times it might not, right? Because there is specific expertise that's needed. And I guess that's, we'll find out in time how that all plays out. But it is, I think that, as I said, over time, the sector has a strategic role in portfolios. There will be managers in this market, but a lot less than there are today. I think we need that rationalisation. And we sort of had that in private equity, right? Through the GFC, we had a lot of private equity groups running around. Now today there's, a dozen high quality private equity managers in the Aussie market, and they're all stronger as a result of what happened. So I think that will play out over time.
This isn't a private credit podcast by any means, but what does it look like when the tide goes out? When we do find out who's swimming without, what is it? What is that for our economy, for our market?
Yeah,
to me, it sounds like a position we don't want to discover.
No, No. I mean, we all watched it from afar when it happened in the US. Now, clearly that was a housing specific issue. Obviously, we're not at those sort of leverage points now. So what's the macroeconomic shock that could happen? And I don't think it's necessarily a private market shock, right? It could be a public market shock that flows through. There are definitely pockets of over leverage, and that leverage has increased in recent times. So I think it's being very wary of it. And the other thing is sometimes, if we think about where some of the cracks are, a lot of it is in the resi development lending space. And if it sort of falls over, can you pick it up at a price point that is cheap enough to make it work out, given developer costs and everything else have gone up, right? So I think it'll be interesting to see how it does play out, and those groups that do have the expertise to work through it, and importantly are transparent to investors on what they hold, and whether we see perhaps other managers coming to this market to raise distress funds to try and pick up some of that. And we're looking at that at the moment, thinking, who would we partner with if this was to really crack open and be ready to go, rather than doing the work at that point in time. Do some work now to think about how this all unfolds, and is there a way to to profit from some of that, because they can often be great buying opportunities.
Awesome. Let's jump in now to how you actually go about getting these different exposures.
Yeah,
because
sure.
if someone was to pull up one of your monthly reports, you go down the page and you actually see two distinct sections. You see your fund manager partners, your manager partners, and then you see the assets underneath.
Yeah.
So do you invest in the assets directly, or do you invest in them through these intermediaries?
Yeah, it's a good question. So we invest via the investment managers, via our investment partners. So we've got sort of 12 investment partners across the portfolio, across the various asset classes in total. We will invest into their funds. In some cases, we will have segregated accounts where we can pick and choose what we invest in based on what they bring us. And the other thing we will do is we will co-invest directly on assets alongside them that might be too big to go into their funds. So some sort of combination of those is how we get our exposures. And really, this is about partnering with best in breed sort of institutional managers in each of these spaces. We talked about water before, right? There's a small number of people that have the expertise in this market to trade water, right? And it's not a real estate group. Right, it's a water manager. So we have the Argyle guys, so Kim Morrison, who we think is the best water investor in the country, managing that exposure on our behalf, and that is all he's ever done for the last 30 years is trade water rights. So we have that exposure via very skilled investment partners, and we're investing in, as I said, sort of funds or assets alongside them, but they're managing those underlying assets on our behalf.
Right. So your job then, day to day, Nick, is to manage the managers.
Yeah,
as
picking
in
managers.
to pick
Absolutely.
managers.
Yep.
I would like you to walk us through then that management selection process, because
sure.
I'm guessing you'd be down to part-time hours if it was just who's got a good track record and are they good people?
Catch someone for a coffee and decide to give them some money. Yeah, it's not that easy. So yeah, it is. Look, it is a really, really rigorous process, and this is something that Dani, my predecessor, and myself grew up with at WTW. So the process looks at a number of success factors. So the things we look at are investment professionals, the approach to managing the portfolio, opportunity set, the firm and the stability of the team, and alignment. And things like alignment are really important. And by the way, those are the same success factors regardless of the asset class. Right? We always look at those success factors, and it's in combination, because you can have, as I said before, you might have a really great opportunity set, but if you don't have all the other parts that the manager's got, then they're not going to deliver. Right. And so things like alignment, if we think about alignment, what are we talking about? We're talking about fees and performance fees, but performance fees are really just an option on the upside. Right. The manager doesn't feel pain when it doesn't go well with a performance fee. Where they feel pain on performance is if they've got equity in the business. That is absolutely key. And if they've invested their own capital into the fund, because then they feel what an investor feels, right? And so it's the combination of those three things we look at to determine how well aligned the manager is with our interests and ultimately our shareholder interests. So those are the factors we look at. And the average time to sort of complete due diligence on a new manager is probably 3 to 4 months. It's probably 2 to 3 months at the short end, and the long end it could be a year of working with someone to agree on key terms. And people often say, "Geez, that's a long time." But we need to build. We need to build sufficient conviction and skill in these groups, because we're often allocating to closed-end vehicles with 8 to 10 years. Like, our time horizon is very long, right? So if I'm giving someone capital for 8 to 10 years, I need to be damn sure they're the best at what they do and they're going to deliver for our shareholders. And so the sort of, the benchmark to get into the portfolio is particularly high because of that.
And so does it become a bit of a weighted scorecard for you guys across those criteria? Because no one's going to,
tick them all.
Yeah. It's going to be rare. And then you'd have little subcategories in each and every single one as well.
Correct. Look, there's no specific weightings, but it is a combination of them, absolutely, right? Because you find this all the time, where you've got a group that really strong, perhaps a bigger group, so maybe they're very strong, big team, stability might be okay, but alignment's a bit weaker because actually they don't have any of the equity. It's a bank-owned asset manager, right? And you're like, oh, okay. So you sort of got to weigh all that up to give a view on, do we think, as I said before, it's sort of, is the opportunity set right? Does it play into our thematics? And do we have a manager that's skilled? Because you can find someone really skilled but playing in a space that's not particularly interesting, and vice versa. And so it's sort of getting all those to line up. And we often like partnering with groups earlier in their life cycle. We tend to find alignment is a lot stronger at that point, and they tend to deliver superior returns than larger groups that have been around necessarily in a long period of time. So
that's interesting then. So for example, for people out there thinking about it, it's like partnering with an Aussie small cap fund manager in the first few years rather than sorry, my cat's woken up and he's
interested in the discussion.
He's interested in the warmth in the home office. And so it's like partnering with a small cap manager in the first few years of their existence. And for a lot of people out there, that might be counterintuitive, because it's you say, well, they don't have a track record.
They don't have the track record. Yeah, exactly. And so, it's a really good point. So often what we're doing is, if we're partnering with a new group, they've often, the person's got expertise from somewhere else.
Or right? That's often a team that's been unplugged.
Correct. Correct. So then we go back and go, okay, how do we find that out? We've got enough networks and contacts to sort of drill down into some of that. Sometimes it's hard. In private markets, it's a bit harder to determine exactly that track record. And then referencing, like, who else knows them, and not references they give us, right? Because they're always positive. It's like a job interview, right? So it's going finding other people that know them, have worked with them, alongside them, and what they think of them, to then determine, actually, we're comfortable because they've actually delivered previously. And you tend to find that performance is a lot stronger in the early years. And often the key investment professionals, if you think about it, in the early years, they're managing the money. As businesses get bigger, what do? They hire more people to manage the money, and then they're managing a business. Right. And those skill sets are very, very different. Right. And so it's finding great investors still managing the money. And that's often means partnering with them earlier on in their life cycle.
I'm curious. I understand you don't want to probably give up the whole process, but what's some key insights that you can give us when you're looking at those people? What are, as in, when you're asking questions or digging into the background, what character traits are you trying to see? Yep. Or find in them that go, hey, this guy's got something?
Yeah, it's a good question. I think it's hard to put your finger on one thing. Obviously, this is all I've ever done. So I've certainly, if you think about sort of average, we'd be meeting 2 to 3 managers a week, right? And that's all I've done for sort of 15 years. So you start to know exactly what you're looking for. I think it's there's obviously a confidence and a knowledge of their market, but a lot of them have that, right? I don't think I've ever been to a fund manager presentation where they haven't had a slick presentation and some in the room in a suit that going through a deck, right? They all look a bit the same. But it's when you get into second, third, fourth meetings, and then sit in and watch their investment committee meetings, right, which we're able to do through our process, watch how they engage everyone else in the room, how they feel when they get challenged, right? Do they get defensive or do they welcome challenge? Are they humble? What's gone wrong? Nothing. Well, that's a lie. Something will have gone wrong. Right. How did you deal with it? What did you change in the process?
One of my favorite examples is, tell us about a mistake you made.
Yeah.
Oh, I sold this amazing stock too early.
Yeah. Try again. Exactly. Try again. Yeah. So it's more that, right? It's let's unpack this and what happened, and it's the openness, it's a transparency. We do quite a bit of work on culture. Culture is a really important one, how they treat both clients, so us, but employees, and then interviewing, junior employees without management in the room to get their sense of it, as opposed to just hearing from management, oh, everything's fine, this is how we do things, everyone's happy. Get everyone else in the room, get their thoughts on why they joined, why they might leave, how important is equity over time, how do you think about carry, all of those elements through the process. It sort of gives you forms that view on whether this group will be successful and are they skilled enough to deliver on the mandate.
And management are happy for you to talk to the other employees?
And to be honest, if they're not, that's a red flag.
Yeah,
exactly.
Okay.
Right.
So, I find this quite fascinating. Let's talk about, though, you're clearly investing in these funds. Funds come with costs. That's the first thing. Like, people go, right, what's the performance? What's the fees?
Yeah, exactly.
So how does that work in your world? Because what people don't want to see, obviously, is a babushka doll of fees. There's fees in the listed investment company yourselves, and there's fees in the underlying. There's performance fees in the underlying.
Correct.
How do you think about that? How do you like them reported to you with that kind of clarity? Because you need to understand what you're getting at the end of the day. Walk me through how you view fees.
Yeah, absolutely. So when we're investing in one of our managers, we're obviously trying to negotiate the lowest possible fee at the end of the day. And this, once again, was instilled into me during my time at WTW. And the benefit of coming from WTW, and the same with Dania, who was previously in this role, is we were negotiating on behalf of some of the largest institutional investors in the world, which mean we got managers down to their lowest point. So we know what they're willing to pay, right, at the lowest possible point, because we represented such a big portion of capital. So that gives us the sort of insight to push managers perhaps further than others.
You don't want to push to the extent where you take the incentive away.
Absolutely right. And it's I often say the best fee negotiations I have with managers is we sit there and we go through their P&L. I say, okay, you need to hire people to grow this strategy over time. What do you pay them? Like, what does this look like, right? Because it needs to be economic for you as a business to grow and sustain that business, but it needs to work for us. Because if you're targeting 10, 12% returns, but I'm going to have to pay 3, 4%, including performance fees, I'm not doing it, right? Like, it's got to stack up for both parties. And that's often where we have the best discussions around what's going to work, what's going to incentivize the team, and what's going to allow their business to grow and palatable for us. Some asset classes are more expensive than others. Private equity is still expensive, right? It has been forever. There's a small number of quality managers that raise capital fairly easily in this market, and so that is still an expensive asset class. Importantly, though, the performance fees on private equity, the groups that we partner with, they're all back-ended, right? So
they're on the exit.
Correct. Yeah. So we often get this question, well, Nick, in the LIC structure, you're trading at a discount. Are the valuations on private equity, are they fair? Should this be always at a discount because it's not fair? There's actually no incentive for any of these private equity groups to mark up their values, right? Because if they mark them up, they then sell the asset at a lower carrying value, right? They'll get 1, less performance fees, and 2, they won't raise money in the next vintage. Right, there's virtually no incentive. There is if it's an open-ended structure, which we have through some of the other asset classes, but in things like private equity, there's no incentive for these managers really. So it's a combination of the management fee and the performance fee. In terms of the look-through, so our fee is 1%, the WAM fee with no performance fee. The reason for the no performance fee is really it's just very difficult to create a benchmark in this asset class.
That's exactly right. What's a fair?
It's near impossible, right? And you can sort of, it's basically impossible. So we have a base fee of 1%, no performance fee. The underlying managers, as I said, it differs based on the asset class. The look-through fees on the underlying managers are currently 90 basis points. That'll move up to about 100 basis points. So it's about 2%. All in, and then there are some performance fees on the underlying managers. Clearly, that's linked to them outperforming, and so we're happy to pay if they're delivering. So that's the sort of look through. And we think, we're probably the other thing to highlight is when we're coming into these, we're investing with these managers, we are coming through as an institutional investor, right? So we are getting the very best fees on their behalf. We've got examples where we're paying 60, 70 basis points for something that a wholesale investor, not retail, because they won't open it to retail, but even wholesale paying 1.5 or more. So we're coming in at significantly less because we are writing institutional size checks. We're coming in at sort of 10 to 20 million for each of our underlying fund investments and co-investments of sort of 2.5 to 7.5 million each.
So I noted in the annual report that there was a section carved out for rebates.
Yeah, so that'll be where we've negotiated rebates with managers. So rather than necessarily just getting a lower rate, we'll pay a rate and then we'll get a rebate back. That's more for sort of accounting purposes on their end than anything. But yeah, that's effectively a fee that we've negotiated with them that's better than their rack rate, which all goes back to obviously our investors.
Yeah, awesome. Nick, let's jump into the history of this actual LIC, because it is fascinating. For people who don't know, the WAM Alternatives LIC originally started life as the Blue Sky. I'll get the BLA was the stock code. It was the Blue Sky. Was it BAF? Sorry, BAF. Yeah, BLA was the headstock.
Yes.
So BAF was the Alternative Access Fund. It, of course, back in 2020, Blue Sky, for those who do remember it, came unstuck in a spectacular fashion. It was an alternative assets manager that was essentially, at one point in time valued at over $1 billion on the ASX. And then after a short report by US hedge fund Glaucus, I believe.
Yes.
Went essentially to zero.
BAF,
the LIC, was one of those assets that was managed by the Blue Sky team. Of course, then along comes Jeff Wilson and a few other people as well who tried to gain control of the investment vehicle. It ended up with Wilson. It was to say it was a bit messy. It's a little bit of an understatement.
Yeah, absolutely. Yeah.
Tell us about the restructuring of the portfolio that your predecessor Dania did to get it to where it is today.
Yeah, sure. So you're spot on. It was pretty spectacular, and I was obviously watching it from afar at that point in time. So Dania came in October sort of 2020 when WAM took over the portfolio, and there's three elements to it. We knew the portfolio needed a lot of work, and being in liquid assets, this takes time. Right, it's not like taking over a listed equity portfolio. You can sell stuff and just buy the new things that you like. Right, this takes a lot of time. So the portfolio we inherited had a combination of private equity, venture capital, water, and agriculture assets. As I said, the water piece we quite liked. Some of the PE stuff was okay as well. The other pieces were legacy assets, and so we were looking to exit those. And as that money came back, Dana and the team then had to reinvest into new strategies. And so that has been took a long time, right? And so we're sort of years. Now, exactly, and we've only really just sort of finished that process, right? That revitalization process. And there's about 18% of the portfolio today that is still left in legacy assets, and those will come back over the next 12 to 18 months. But today it feels, it is a WAM portfolio. Right, largely, this is something we have built, which is great. Those other assets will come back. Probably the other elements, though, when we took the portfolio on so there's the portfolio piece, there was the income piece. So when we took this on, the profit reserve was basically nil. We were looking at a dividend cut, and so we've been able to build that profit reserve back up, which has been a great result for investors. We're now paying a 5.6% yield or 8% grossed up with franking. And importantly, we've got 3 years now of dividend coverage. So that's really good from an income perspective. And then the final thing, and this was probably the one we probably underestimated, and it's hard to find a better word than toxic. The register that we took on was pretty toxic.
When you talk about register for the shareholder register,
yeah, exactly. And so when we took this on, there was, if you think about Blue Sky were, in some ways quite visionary in listing this thing back in 2014, right? We talk about this, the democratization of alternatives and giving investors access to it. That was 11 years ago they listed this and gave people access to it, which is, great. And so we've been able to obviously have to work through the issues in the portfolio and the income piece. But the challenge with the register is you had a lot of investors that had gone in and obviously been burnt through that Blue Sky process. And so where we sit today is 60% of the register that we inherited from Blue Sky back in 2020 have now sold. and 70% of the investors on the register as we sit today are new investors since we took on the portfolio. And of the total register, 45% own 2 or more WAM LICs and a third own 4 or more. Now that it's just taken a long time to work through that repositioning of the register, and a huge amount of work from Dania and the team here before me on educating our client base, our standard, the WAM shareholder base on the value of alternatives, how it can complement an existing portfolio. And I think we probably thought some of that register piece would happen more quickly, but it's taken a while to pan out. But it does feel like today the portfolio is now largely a portfolio we have built. The income is in a much better place than it was when we took this company over. And importantly, the register is a WAM aligned register. And so it feels like the company is in a much better position than we were 5 years ago, but it has taken time to get to this point.
Why is a good share register?
Yes.
Good shareholders important. Why? Because, at the end of the day, it's you managing the money.
Yes. Yeah.
People and the beauty of an LIC is if you don't like it, if you need to liquidate or whatever, you can sell it. You can move on, and the assets remain there. It's not like an open-ended fund like an ETF or a managed fund where the underlying manager might be forced to sell investments. Correct. So what impact on, like, say, me if I'm a shareholder of WMA and I'm happy to hold on it, why do I care that old mate over here is disgruntled?
Yeah, so the key thing is if you don't have a register that's well aligned, and Jeff always talks about tightening the register, right? Have it a tight register that's supportive will mean the share price is supportive and it will trade closer to NTA. Right? If you have a shareholder register that is not supportive, you will trade at a discount. And this vehicle has traded discount since we took it on, right? And that's been a challenge. And that's why it's important to we've had to do that work on the register to get it more aligned, to tighten it up so that we can get this to trade up closer to NTA and ideally at a premium over time.
Fantastic. So let's talk about it though as well, because something overhanging the LIC right now as we speak is still got to do with the blue sky issues. And this is relatively unique as well to this particular LIC here in Australia. These types of clauses that I'm going to mention are a little bit more common if you do go over and have a look at listed investment companies in the UK. But when it was restructured from BAF into WMA, a clause got put in, and it was a 5-year clause where if the LIC doesn't trade at a premium for 3 months, a total of 3 months out of the 5 years, the shareholders will get a vote to potentially wind up the LIC. Just so happens that 5 years is this year. That vote will be happening at the next AGM. So, you've been in the seat for 4 months. You don't want to be looking for another job in a few months.
Correct.
Can you tell us about, so it was a premium target clause?
Premium target clause, yeah, that's right.
And so I know from speaking with you, it has been the closer we get to that time period, it has been a little bit of a handbrake as well. Yeah. Because people say, well, hey, why should I invest in it now if there's a possibility that it's going to be wound up? Yeah. But also, if we look at the shareholders that have held on, they haven't had a great ride. So some of them might think, hey, look, I'm trading at a 16% discount or whatever it is at the moment. Why wouldn't I just say, I'm out, let's vote to wind this up and get my money back?
Yeah, spot on. So you're right. It was my first question to Jeff in my interview, am I going to have a job in 12 months? I've been with WTW for 12 years. I'm not coming here on a contract. So what's the plan, right? So the way, you're right. So the premium target vote, the mechanics of it are as follows. So it's a special resolution. So it requires 75% of the voting register to vote to terminate the management agreement and wind up the company. Now, that's of the voting register. And typically when we have these sorts of clauses, which aren't that common, as you said, only sort of 65% of the register will vote. We obviously want that higher so we get a clear indication of, the register and where they're heading. But in effect, we only need 25% on the other side for a continuation of the company. One of our biggest client is an advisor. They hold about 14% of the company, and they are very supportive. This goes into all their client portfolios and the model portfolios. And that, coupled with internal staff holdings, gets us closer to 20, and other advisors sort of get us past that 25. So we're very confident we will get through it. But as you said, Mitch, the challenge we're finding at the moment is there are groups that aren't currently investors, especially advisors, looking at it going, geez, this is a really interesting portfolio. I think this is a really high quality portfolio. But what's this vote, right? Do I want to go and recommend this to all my clients, and then there's a risk this thing winds up and I end up with egg on my face, right? And so the vote was put in place to create alignment with investors, and it did that day one, and it's probably doing a bit of the opposite at the moment. And so I do think I'm very confident we'll get through the vote at the end of the year. And importantly, we can grow from there, but it is sort of probably holding some buying back a little bit. And another question you asked, well, what about the investors haven't had a wonderful experience, right? This has taken time to work through the portfolio. The performance since we took it on, the underlying performance is sort of 9% over the last 5 years, but the 1 and 3 year numbers have been weaker as we've had to reposition the portfolio. The challenge we've got is that these are illiquid assets. And I had this conversation with an investor recently who sort of said, well, Nick, why don't I'll vote to wind it up and then I can get NTA. I said, that's fine, but in reality, I can probably give you NTA in 4 to 5 years. Right, these assets are tighter, and that would be doing well, right? We'd have to be selling secondary assets at sort of NAV or only a slight discount, and getting upticks on the other side to sort of work through the portfolio. We've got new commitments to 10-year vehicles, right? So it would be, we'd have to do a lot of work just to get it done in sort of 4 to 5 years. If you could wrap it up and get NAV, NTA the next day, then that's obviously a very different proposition. But so that's probably the challenge is that. And I think as well, coming back to that point I raised before, like tightening the register, I think through the vote, we will tighten the register. I think there's support there. Anyone that does vote, to wind it up, if the vehicle does continue to exist as we expect it will, they will sell, we'll tighten the register further. We can then get it to trade up and grow the vehicle over time. But it is acting as a bit, there's probably a bit of an overhang there and so we're sort of keen to, let's get on with it. We'll have the vote. We're confident we'll get through it, and then we can grow it from there, because the portfolio is a cracking portfolio. It's positioned for growth, and I think it would be a detriment to everyone if this was wound up.
All right, Nick, let's go on to a couple of reflections now. 2 questions that we often ask all of our first-time podcastees. Nick, this is one Owen always asks. If you could go back in time and give younger Nick one piece of advice on life, investing, business, etc., what would it be?
Yeah, okay, interesting. So on life, so I sort of my late wife lived by the serenity prayer. So God grant me the serenity to accept the things I cannot change, the courage to change the things I can, and the wisdom to know the difference. That's something that sort of always guides me in decisions I make and with my family as well. On investing, be patient, be humble, are probably the 2 things. So they're probably the key things. And trust your gut. I think you just learn to trust yourself, what you know, what you don't know. Ask questions if you don't know something. There's no silly question. That's how we learn, right? And we're always learning, as you said before.
Right. And now this is one from me. I'm coming up to Sydney. Me and you are going to lunch.
Yeah.
We're not coming back to the office.
Yeah. Sounds great.
Where are we going? Where are we going? What are we eating?
I like this question. So hopefully the sun's out today, so we're going to go down to China Doll at Woolloomooloo Wharf.
Ah, yes, I know.
And we're going to settle in there from lunchtime. Maybe a couple of cold beers to start. The duck pancakes are really good down there. Yeah. Some wine, and then maybe finish the night over at the Woolloomooloo Hotel.
I'm very familiar. Nick, awesome. Thanks for joining us, mate. I really appreciate your time walking us through the holdings, your investment process with the managers. I actually quite enjoyed hearing about that manager process, and then getting into the nitty gritty around the history of the LIC, and because it is fascinating. If anyone wants to, I'll try and find a couple of articles about that blue sky circumstance and pop them in the show notes, because if you're not familiar with it, we don't get too many incidents like that here in the Australian market.
It was a big one.
It was a pretty big deal at the time. So I'll pop some notes in the show notes. Nick, thanks for joining us, mate. I really appreciate your time, and we'll definitely catch you again.
Absolutely. Thanks, Mitch. Cheers.
All right. Cheers.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.